it is a really interesting topic, and I think we're at a very sort of formative and pivotal time on lots of these topics, and that's why it's great to have Karen here today from the CSSF to discuss some of the changes that are happening in the field of DLT, CBDCs, and also crypto. The way I suggest that we have this discussion today is we sort of break it down functionally. So first, we're going to talk about DLT as and its impact on traditional securities. Then we're going to talk a little bit about DLT and its impact in this sort of new field of crypto, and then we'll try and bring it all together at the end. So with that being said, Karen, great to have you here. Maybe just to start off with, we could talk about adoption of DLT in securities issuance. What sort of take-up are we seeing so far in that kind of field of securities issuance?
Okay. So I think the DLT is clearly something that we see a growing interest in. Yeah. So there was a slow interest, but it's certainly growing and developing. I think it's interesting to see that with the DLT, and when we talk about the different assets on the DLT, we can either have financial instruments or non-financial instruments. And I think the distinction is quite important because depending on the distinction, it really determines which regulatory framework you may fall under. And with the DLT and the uptake in the use of the DLT, because of the advantages that it can bring to business and to the way of doing things, there was also a change in the MiFID definition of financial instruments, so that financial instruments that are on the DLT can still be considered as financial instruments and would remain, we'll say, within the more traditional regulatory framework. So the main kind of projects that we're seeing at the moment, I can break them into three different types of topics. So the first one is to do with investment funds. And there what we can see is the native tokenization of investment funds. Yeah. And by that what I mean is really tokenizing the shares of the investment funds, but maintaining the register on chain as well. Okay. So it's really everything is within the DLT, and the tokens, so the real fund shares or units, are on the DLT on a register. In that case, the transfer agent, so the traditional transfer agent, is still required, if you like, and he will then is responsible for the register of those tokenized fund shares that are on chain. The second use case that we see is the non-native tokenization of the same investment fund shares. And there really we have the register, we say the official register with the transfer agent, which is off-chain, but we have the non-native tokens which are on-chain, so the representation, or we'll say the digital twin of the fund units, which is on-chain, but that's usually used for internal management purposes. Okay. And in that case, so those register, because there's no real, we'll say, legal kind of right that goes with it. You don't need a license for those register because it really is just an internal record keeping on chain that's replicating what's there off chain with the traditional players. And in that case, there's no impact on the investor. So whether it's the token or the real, we say the materialized fund share that they have, there's no difference in their rights, their benefits, their rewards, and how they interact and how they can use those shares. And then the other use case that we see more and more is really the tokenization of, we say, the real world assets. So there it's things like art and real estate, which is the two main ones we see. And there it's really tokenizing them and having the secondary market for exchanging those tokens around those real kind of real life assets. And I think they're really the cases that we see the most. And that we're more in contact with. Okay,
so really funds and RWA to use the fun acronyms in this field. One of the things that happened back in, if I remember correctly, 2023 was that Europe put in a pilot program into place for use of DLT essentially in fields related to securities services. And I think ESMA came out with a kind of summary of how things are going so far in May this year, which really highlighted the relatively low take-up in the program. I was wondering if you maybe had any reflections on, even though we're seeing obviously use cases develop in this field, why there's been such a low take-up in these kind of programs that are kind of specifically designed for...
Yeah, you're right. I think there's only about 6 or so projects that have been kind of or at least discussions that have been initiated, and nobody has received permission to actually launch the project so far. Yeah. So you're right, there's very slow uptake. And the whole idea around the project initially, so the pilot regime, was really to enable the use of DLT in really the trading, the issuing and the settlement of financial instruments. instruments. And there's different status, if you like, that's possible. So you have the DLT MTF, which is the multilateral trading platform, the DLT SS, which is the settlement system, or a DLT TSS, which is a combination of the two. So you have the multilateral trading platform and the settlement system. So really you're looking, it's replicating kind of the, again, traditional models of really an MTF operator or a CSD.
Okay.
So that's kind of the basis. It's not a license, or it wasn't developed as a license. So you don't have a license to perform one of those functions. Rather, it's exemptions from, again, the pre-existing regulation to really test how the traditional world can work with the DLT to make it more efficient, perhaps, and to add the advantages of DLT. I think that there has been, as you said, a very slow uptake, and I think in my view anyway, there's three main contributors. So the first is that the instruments that you can use the project for are very limited.
Okay.
So it's shares, bonds, and fund shares. So it's very, very limited. So that kind of limits the scope. So, and I think particularly when we're looking at DLT, because a lot of the crypto assets using the DLT, they're outside the scope of the pilot regime. The second limitation perhaps is the size of the issuance, because again there's limits on the market capitalization that of the instruments that can be put into the DLT pilot regime. So it kind of limits it as well. And for me the third one is really the uncertainty in the time frame, because you said it's a pilot regime. It was for 3 years and to be extended for a further 3 years. So you're looking at a 6-year period. And then there is your report soon to see how it's going, to see whether it needs to be extended beyond that 6 years. And I think there's a lot of investment that needs to be done in the companies to be able to build the structures, to build the systems, to test the use of DLT. And because of the uncertainty around the length of time that it'll actually be operational, I think that's a hindrance for certain people. Something else that's important as well is the end-to-end system. And I think we have the pilot regime, which is looking at the trading platform piece, the settlement piece, but it doesn't cover the whole end-to-end system. So things like the cash leg at the end. So with MiCA, there are possibilities perhaps with EMTs or ARTs to have the cash leg, which is also digitalized, but that's not yet in place. Soon, but not quite. And I think so the timing difference between when the DLT pilot regime came into place, when MiCA will perhaps be able to offer some solutions to complete the chain, it also makes it a little bit more difficult.
So really it's limitations in terms of scope, time frame, and asset classes.
And uncertainty.
And size, they're kind of creating some limitations there. And actually that segues quite nicely onto the next topic, which is, Thomas Moser was here from the Central Swiss National Bank yesterday talking about Project Helvetia, and we've just had the report published by the Banque de France and BCL on the cash side of Project Venus, which was a tokenization and then a primary issuance of an EIB bond with Goldman Sachs. And it does seem like that there's some thoughts around providing essentially an on-chain central bank money leg, at least in the wholesale kind of space. I was just wondering if you kind of had any thoughts or reflections on, you've already mentioned EMTs and ARTs as a potential solution. Is there a need for something like a central bank digital currency for this to really take off or not?
So I think there's a need for some form of digitalized kind of currency, if you like, to ensure the settlement, again, to make sure that the whole system from end to end is functional. So there's clearly a need for something to complete the end piece. Does it need to be central bank digital currencies? I think with MiCA and some of the other provisions, there's possibly alternatives today, or at least there will be alternatives, which is maybe the EMTs, the ARTs, tokenized deposits, things like that. So there is a move to perhaps offer some solutions, but then those more commercial type solutions probably have different risks as well. And I think working with a commercial digitalized token, so be it an EMT, a tokenized deposit, isn't the same and doesn't give the same kind of confidence as dealing with central bank money. So I think it's possible solutions, but possibly then with other risks as well.
It is certainly a challenge, especially considering the fact that capital market settlement today really takes place against a central bank money leg. So it is a kind of like a shall we say, reduction in money quality to a certain extent to move back to a sort of commercial bank money solution. But it's an interesting space to see some progress in. Okay, so maybe switching over now to the fun new asset class of crypto. I mean, obviously in Europe, we're in the throes of the actual introduction of the MiCA regime now, with some initial introductions coming in June, if I remember correctly.
30th.
Yeah. So in a couple of days' time, and then the full implementation at the end of this year. One of the questions that I've always had about this is, the approach that the European Union has taken here of setting up a dedicated framework for crypto assets contrasts quite sharply with other areas of the world, particularly, for example, if we're looking over the pond at the way in which the more, shall we say, litigious method around that's being used to kind of arrive at a regulatory understanding of crypto assets. So I wondered if you had any views on whether there is really a necessity for a separate legal framework here, and what advantages there are, if so.
So I think one of the key differences is probably, why Europe has kind of adopted this approach and has MiCA, or will have MiCA in the coming days or coming months, compared to other jurisdictions, I think, is how Europe, generally speaking, looks at regulation and legislation. And generally speaking, in Europe, it's more of a principle-based type approach to regulation rather than a pure rules-based approach, which has its advantages and disadvantages, that's for sure. But because it's a principles-based approach, I think really what the European legislature did to start with was say, okay, there is this market, crypto assets are here, people are using them, the retail investor is using them or is investing in them, and there's a use case for their existence. So either you change the rules and try and fit it into an existing rule that are there, which doesn't necessarily fit because we don't have very kind of prescriptive rules at the moment, it's principles, or we look to see what we have and say, well, what do we need to complement it? And I think the starting point is really the asset that we're talking about. Is it a financial instrument? And there we have a definition with principles, with conditions. Is it a financial instrument? If it is, well, then you remain within that framework that's there today and you apply the rules that are applicable. And it was more, well, what happens if it's not a financial instrument? And that's where the MiCA framework was created. And it's really heavily inspired by the MiFID framework. So kind of lifted out big chunks of the MiFID framework and then completed it with things that are more specific because of the nature of the activities or the nature of the assets themselves. And I think the necessity is really to ensure there's consumer trust. Because again, the market is there. We can see retailers investing in this type of assets. Unfortunately, there has been a lot of scandals, a lot of individuals who at the end of the day have lost money. And that's something that at a European level we're trying to stamp out. And that's why the framework was put in place to really put in place rules and requirements, particularly around internal governance, around internal controls, around how things need to be managed, how the risks of the assets themselves and the activities need to be managed, so that ultimately consumers can have trust when they're kind of parting with their money and investing it in this kind of asset. And I think that's kind of the necessity of it. The advantage then of having more of a principle-based approach. So there's some pieces that have been clearly excluded from scope of MiCA to start with, because it's impossible to cover everything. Having said that, by having more principles rather than hard and fast rules, it means that it's more future-proof, because as regulators, as legislators, we're always catching up on the market, so the innovation is there, the innovation is very quick, and then we're always trying to play catch-up. And by having those principles, it means, I think, it's more future-proof, and that going forward, as different assets are evolving, there should be a way of pulling them into the framework to make sure there's the same level of governance, the same level of control, of risk management, and ultimately protection of consumer assets. And I think for me that's the advantages, as well as having the system the way it is to be able to capture what's going to come that we're not aware of tomorrow.
Future innovation. I mean, obviously the crypto assets have to a certain extent already been covered by some regulation, and particularly around anti-money laundering regulation previously in the VASP regime that was in place. How's that transition? How do you see that transition going from a VASP regime into the kind of new future MiCA kind of environment in the CASP regime?
So very smoothly. It's a long, bumpy road, but we've got really thick tires, so it'll be a smooth journey. No, it's. I think there's a cost. The cost is also depending on the current size of the company. So if you look at the register that we have on our website, we can see that some of our VASPs, we say, are only VASPs, and other of our VASPs also have another financial sector license. When you have another financial sector license, you should have already in place your internal governance arrangements, your internal controls, your structure, your risk management function, and things like that. So there, the transition is possibly slightly smoother because there's a certain amount of that groundwork that's already in place. But even though there is already those controls and internal governance arrangements, they really need to be tweaked to make sure it's capturing the specificities of the crypto business, if you like, and the risks that are intricate to that business and not the more traditional risks. So even if we say it's AML, it's IT, it's operational risk, yes, but it's different and it needs to be looked at differently and incorporated into the internal controls differently. But when you have a basis, you have something to build on. For the VASPs that today we say are only VASPs, well, there's probably a heavier process and heavier arrangements that need to be built, but the requirements are there, and they're well known because, again, as I said, what's been put into place under MiCA is very close to what's requested today under MiFID, or at least there's a lot of parallel, so it's not completely unknown. But there is certainly a big deal of work that needs to be done. But it's and as I said, there is a cost, but there's the upside, and really the advantage is that once you have a CASP license, you can passport your services throughout Europe. So really, the whole of the European marketplace can become your client base. Whilst today, as a VASP, it's if you're registered in Luxembourg, it's only the Luxembourg market. So the benefit comes with a cost, and I think what's very important then over the coming months is really transparency between, say, the market actors and ourselves, and flexibility. Because whilst the regulation is there's some of the level 2 texts are already finalised, but quite a lot of the level 2, level 3 texts are still under discussion and not finalised. So there's still a little degree of uncertainty as to what will be the final requirement. But I think it's very important to start the conversations now. And both sides, we have a learning to do. So as a regulator, we need to probably learn the practical operations and the practical implementations of some of the rules and how you can transform the requirements into internal policies. Whilst on the market side, particularly in the VASPs that are only today subject to the AML regulation, I think they need to learn how to deal with regulation and kind of accept the regulation. Yes, it's a cost. Yes, it can be a pain. Yes, there's lots of requirements. But again, there is the positive side to it. And I think there needs to be a little bit of flexibility on both sides today to kind of engage on that learning curve together. And get through the coming months. And I think afterwards, the last thing is really to start preparation now, because even though the CASP licensing will come into effect at the end of the year, so realistically 1st of January next year is when we'll be able to start issuing those licenses. In the draft law that has been filed, there's an 18-month grandfathering period, meaning that for the VASPs that are registered today, they can continue their activities for that 18-month period before they will need a CASP license to continue. But even if we've 6 months and 18 months, that's relatively short period of time, particularly with the amount of work that needs to go into place. So it's really starting the transition now.
Okay, so step up and start talking to your regulator as soon as possible, basically. Maybe just also focus on then, the fact that there's a regulatory framework there potentially, unlocks perhaps more institutional interest in crypto as an asset class. I mean, is that something that you're kind of already seeing? Is it primarily new institution catering to institutional actors, or how would you see that?
So I think what we're seeing is, and again, I think it's linked to the structure of the Luxembourg financial sector, which is a very institutional financial sector, which again has a cross-border focus, but more institutional. And our domestic market is rather small, particularly on the scale of Europe. The majority of the interest that we're seeing is more towards the institutional side. So that doesn't mean there's no retail piece, but the vast majority would be more to the institutional, and I think collectively building up the Luxembourg financial sector. So I think that's where the focus is.
Okay, I'm just aware of time, and we've got about 5 minutes left. So just to maybe wrap up with two final questions. The first is, if we zoom out, crypto is a global asset class, and DLT often is thought to kind of transcend borders. So do you think that there needs to be some sort of regulatory coordination or harmonization when it comes to DLT for securities frameworks or DLT for crypto? I mean, should there be some more international sort of rules kind of applied to this kind of field?
No, I mean, regulators, we cannot work on our own.
Yep.
And as you said, the nature of the assets that we're talking about are global. And they don't know where Dudelange stops and where Volmerange starts. So we can't do that either. And it's not just Luxembourg. I think overall, and first of all Europe, but then even beyond the European borders, the regulators, we need to be aligned. We need to be harmonised. And the harmonisation on one side and the alignment will stamp out the regulatory arbitrage, which is not positive for anybody, least of all the final investor.
Yeah.
So and that kind of harmonization, cooperation should help combat that and stamp it out. But then we also need, particularly as you said in DLT, more outside Europe coordination as well, because we need to ensure the interoperability of the systems that we're putting in place. Because again, if we have a system that can fully functional within Europe but can't connect across the water, well then there's a breakdown in the system, and the advantages of having anything on chain and the speed and the efficiency of it is broken down, and then you're being forced into the off-chain world again. So I think it's very important to have that coordination and harmonization. And I think as well as that, by having the coordination and harmonization, it also gives certainty to the market. So be it certainty around legal qualifications, legal assessments, legal interpretations, which is important then for the players to know how they need to structure the business, what they need to do, what they need to comply with. But also particularly in the DLT pilot regime context, more kind of stability or certainty around timing. And how long will this kind of regime continue? Because again, as we said earlier, there is an investment, and you need to be able to
costs, essentially. And then last question, if we were to get out our crystal ball and project forwards in time into the midterm, 5-10 years in the future, how do you see we're really at the early stages here. How do you see the picture progressing in the future? I mean, are we going to see convergence here between the crypto worlds and the traditional worlds, or is it run along separate rails? How do you see it? How do you see things developing?
I think there will still be a need for both independently.
Okay.
I don't think tomorrow or in 5 years' time there will be, say, for instance, no cash whatsoever.
Yeah.
But I think on certain of the services or certain of the activities, there will probably be more of a convergence. I mean, when you think of it, 5-10 years ago, we never would have thought that we can go around with just our telephones in our pocket and buy everything we need with our telephone and nothing else. And that's where we are today. And I think that innovation is going to continue. And I think there's a desire from the market, be it institutional or retail, for rapidity, for efficiency, for more digitalization. So I think that's going to be replicated in the business models that we see, and then digitalizing assets that helps kind of pass those efficiencies and pass those benefits down to the consumer. So I think there will be a lot more innovation and kind of pulling together of the two worlds. Again, not on one replacing the other, but clearly pulling them together and moving forward, and ultimately probably being able to offer a more holistic and a more efficient kind of product offering to the retailer.
Yeah, I mean that's ultimately it, isn't it? I mean you're doing this in order to create a better user experience ultimately for your end investors. And by the sounds of it, things are only going to get faster. So you better be acting now if you're not already. Thank you very much for taking the time to speak to us today. And enjoy the rest of the conference, chaps.
Thank you.
Okay.